Hey everybody, happy Friday and welcome to Wade's Weekly Update. Today is September the 12th and I, of course, am Wade Byers, the helpful mortgage man with First Community Mortgage here in the Mt Juliet, Middle Tennessee area. So I hope everyone had a great, productive and successful week. I feel like I've had a very productive and successful week, so I hope that goes the same for you. And we're all looking forward to a fun-filled weekend full of football probably. So this week I want to touch on mortgage insurance a little bit. Mortgage insurance can be a little confusing, especially for first-time home buyers. So I thought I would kind of just discuss what it is, what it does, and kind of the different types out there. You know, in a conventional mortgage, you have private mortgage insurance. When you're dealing with government loans, you could have like FHA mortgage insurance premiums. USDA has guarantee fees, and of course VA has a guarantee fee as well. So mortgage insurance is defined as insurance that protects a mortgagee against loss because of default in payments by a mortgager. So in other words, the borrower doesn't pay their mortgage, they have to foreclose on the home. The mortgage insurance is actually protection for the lender for that. So while homeowners insurance gets mixed up in there a little bit sometimes, homeowners insurance is specifically for protecting your home against loss. So essentially what mortgage insurance does is it allows the borrower to buy a house without investing 20% down. So essentially lenders are only willing to lend up to about 80% of the value of a home, which means you would need to put 20% down. Well, in a conventional mortgage type situation, you can actually put down 5 to 15% down, below 20%. And then these private mortgage insurance companies are actually private entities that come in and provide insurance for the lender to protect against that extra shortfall above 80%. So it's really just what you're paying is the right to not have to put 20% down when you do that. So the mortgage insurance can come in many forms. Typically, it is paid monthly in your mortgage. In your mortgage payment, just added into with the total mortgage payment. It can actually be all paid up front, and a lot of times it can be paid by the seller or even the lender. So that's typically on conventional mortgages. It's called private mortgage insurance, or PMI. Government loans are handled a little bit differently. FHA loans only require a 3.5% down payment, but that government entity is holding the risk for the low down payment. So in an FHA mortgage, you actually pay a monthly mortgage insurance premium and an upfront mortgage insurance premium, and that upfront premium can actually be rolled into the total loan amount of your loan. VA loans have no monthly mortgage insurance or mortgage insurance premium of any sort, but they do have an upfront guarantee fee. It's actually called a funding fee with VA, but that funding fee can also be waived in a lot of cases for disabled veterans that have been disabled due to service. And then with USDA rural development, that is also a 100% financing loan. You pay an upfront guarantee fee that can also be rolled into the loan, and then you pay a small monthly mortgage insurance premium. That's really, they don't call it an insurance premium, but that's basically what it is. And it's pretty minimal, to be honest with you, but that's a really good loan. So that's really kind of the gist of mortgage insurance. Really what it is it gives you the ability to buy a house without putting 20% down, and it gives protection to the lender for that. So, but if you ever want to talk about mortgage insurance, anything I can do to help, I am here to help in any way I can. Give me a call or shoot me a text at 615-335-3356. And again, I am Wade Byers, the helpful mortgage man. I hope you guys have a great weekend, and we will talk again next week. Bye-bye.